It's a Tuesday morning. You're standing in your kitchen, holding a cup of chai or coffee, half listening to the morning news while your kids argue about backpacks and shoes. Your phone buzzes. You glance down casually, expecting a delivery notification or maybe a reminder from school. Instead, you see three words that make your stomach drop. IRS penalty notice. For a moment, you tell yourself it has to be a mistake. You pay your taxes, you work hard, you follow the rules. Then you open the email. The subject line continues, Unreported foreign financial account. And below that, a number jumps off the screen, 16,536. Your heart starts pounding. You scroll faster, trying to understand what this is about. And then it hits you. That old savings account back home, the one your mother's name was on, the one you barely used, the one you honestly forgot about. You never thought the United States cared about a small bank account in India, Pakistan, Nigeria, Mexico, the Philippines, or anywhere else. You never imagined that something sitting quietly in another country could suddenly threaten everything you've built here. Your green card, your citizenship application, your reputation, your savings. But here's the reality almost nobody warned you about. America does care. And by 2026, the system designed to find unreported foreign accounts is more powerful, more automated, and more unforgiving than ever before. This isn't just about a fine. This can affect your immigration status, your citizenship interview, your ability to ever feel fully secure in this country. And the most dangerous part? Most immigrants don't even realize they've stepped into this trap until that letter arrives. So in this video, we're going to slow everything down. I'm going to show you exactly how this happens, why so many completely honest, hardworking people get caught, and the specific steps you can take right now to protect yourself before a forgotten account turns into a $16,000 nightmare, or worse. Hi, I'm Sofia, and welcome to Borderless Pathways. On this channel, we break down immigration and financial rules that directly impact immigrants in the United States, clearly, calmly, and without the legal confusion that leaves people scared and overwhelmed. If you are a green card holder, a naturalized citizen, or someone preparing to file your N-400 for naturalization, this conversation is not optional. It's essential to your long-term security here. Today we're going to talk about foreign bank accounts, FBAR reporting, FATCA rules, worldwide income, and the very real way a simple reporting mistake can delay or even derail your citizenship. But we are not here to panic. We're here to replace fear with clarity. I'm going to show you where the $10,000 rule confuses people, how the IRS already receives foreign banking data, what good moral character really means in a citizenship interview, and most importantly, the legal protections available if you made an honest mistake. So let me say this very clearly at the beginning. Having a bank account in your home country does not make you a criminal. Supporting your parents does not make you a criminal. Owning property abroad does not make you a criminal. But not understanding the reporting rules can create serious consequences. By the end of this video, you'll know exactly what applies to you, what deadlines matter in 2026 and beyond, and what steps to take tonight to make sure an old account never threatens your American future. Let's start with what I call the trap. Because this isn't random and it isn't just bad luck. There's a pattern in who gets caught, and once you see the pattern, you can avoid it. The trap has three layers. If you miss all three, you end up staring at a penalty notice you never saw coming. The first layer is the $10,000 misunderstanding. Almost everyone has heard some version of this rule. If you don't have more than $10,000 in a foreign account, you're fine. So people relax. I don't have $10,000 just sitting in one foreign account, they think. I'm safe. But that is not how the rule works. The law doesn't care how much is in just one account. It doesn't care what the balance is on December 31st. It doesn't even care what's there right now. What matters is this: the highest combined total across all your foreign financial accounts at any single moment during the calendar year. Let that sink in. Not one account, not the year-end number. The highest combined balance, even if it happened for one day in January when money was moving. So imagine this. You have a savings account back home with $4,000, a small checking account with $3,500, and maybe a fixed deposit or insurance policy with a cash value of $3,200. Separately, none of them crosses $10,000. But together, That's $10,700. If, for even one day, those balances existed at the same time, you likely triggered an FBAR reporting requirement. Even if by the end of the year the accounts were nearly empty, even if the money was just passing through, even if the funds technically belonged to your parents but your name was on the account, even if you forgot the account existed, the requirement was still triggered, and most people never realize it. That's layer one. Layer two is the part that makes people really uncomfortable. The IRS doesn't need you to tell them first anymore. In the past, people assumed, my home country's bank will never talk to the US government. That might have felt true in 2005, but today, under a global agreement called FATCA, the Foreign Account Tax Compliance Act, banks in more than 100 countries are required to report information about accounts held by US persons. That means your bank in Delhi, your savings account in Karachi, your account in Lagos, Manila, Guadalajara, or almost anywhere else. If your name or tax ID is connected to it and you're a US citizen or green card holder, that data can be transmitted to the US government quietly and automatically. And instead of hiring thousands of new agents to dig through paper files, the IRS now uses automated systems and artificial intelligence to cross-reference that foreign data with the tax returns you file here. The system looks for mismatches, accounts reported by foreign banks that don't appear on your FBAR, interest income abroad that never shows up on your Form 1040. It flags patterns and sends notices. So when someone confidently says, the IRS will never find out about that small account, they're thinking about an older world. Layer 3 is where the trap connects directly to citizenship. If you're applying for naturalization using Form N-400, one of the requirements is that you demonstrate good moral character. During your interview, you'll be asked questions not just about civics and English, but about your tax history. Have you ever failed to file a required tax return? Have you ever failed to report income? Have you ever lied to a US government official? Now imagine this. You were required to file FBARs for several years and didn't. You also didn't report small amounts of interest from your foreign accounts. On your N-400, there's a question asking, in essence, whether you have complied with your tax obligations. If you check no to tax problems or answer no during the interview because you simply never reviewed this issue, you may have just made a false statement under oath. At that point, it's not only a paperwork issue. It can delay your application, trigger further review, or lead to denial. And if there's evidence that the failure to report was intentional, it can open the door to much deeper legal trouble. Do you see the pattern? The trap is not just financial, it's legal, it's immigration. It's about your long-term safety in this country. Now, let's shift from the trap to the shield. Because the law doesn't only punish, it also provides tools to fix honest mistakes. But those tools only help if you use them correctly and on time. The first shield is something you've already heard mentioned, FBAR. The full name is the Report of Foreign Bank and Financial Accounts, officially filed as FinCEN Form 114. Despite the word tax, FBAR is not filed with your tax return. It's filed electronically through the Financial Crimes Enforcement Network, FinCEN, system. The basic rule is simple in theory. If the combined total of all your foreign financial accounts exceeded $10,000 at any point during the year, you must file an FBAR. For the 2025 tax year, that FBAR is due April 15, 2026, with an automatic extension to October 15th. You don't have to request the extension, it's built in. But automatic does not mean optional. It just means you have until October to get it done. What counts as a foreign financial account? Not just a traditional savings account. It includes savings and checking accounts at foreign banks, joint accounts where your name appears even if the money isn't yours, accounts where you only have signing authority, like a business account for your parents' shop, certain foreign retirement accounts, some life insurance policies with a cash value, investment or brokerage accounts overseas. If your name is attached and the combined balance crosses $10,000, reporting is usually required. Now the word that scares everyone, penalties. If the IRS decides that your failure to file was non-willful, you truly didn't know, and there was no intent to hide, the penalty can be up to $10,000 per violation, often per year. If the IRS believes the failure was willful, meaning intentional concealment, the penalty can jump to the greater of $100,000 or 50% of the account balance per year. In the most extreme, deliberate cases, criminal charges are possible. That's why this isn't something to fix casually or with guesswork. But there is a shield inside the shield, the Streamlined Filing Compliance Procedures. This is an official IRS program, not a loophole, that exists specifically for people whose failures were non-willful. If you realize you should have been filing FBARs and reporting foreign income, and you come forward voluntarily before the IRS contacts you, you may qualify. Here's what that usually looks like. Under the Streamlined program, you typically file amended tax returns for the last 3 years to include foreign income. File any late FBARs for the last 6 years. Pay any tax and interest you legitimately owe. Sign a non-willful certification under penalty of perjury, explaining that your failure was due to ignorance, misunderstanding, or negligence, not intentional hiding. If you live outside the United States, penalties under this program can sometimes be reduced to 0. If you live inside the US, there is often a single reduced penalty, commonly around 5% of the highest aggregate balance of your foreign accounts during the covered years. Compare that with potential willful penalties of 50% per year. The difference can literally be tens or hundreds of thousands of dollars. The second shield is Form 8938, which is related to FATCA and is filed with your regular tax return, Form 1040. Unlike FBAR, which kicks in at $10,000 and focuses mainly on bank-type accounts, Form 8938 has higher thresholds and covers a broader set of foreign financial assets. If you live in the US and are single, you generally must file Form 8938 if your foreign financial assets exceed $50,000 on the last day of the year, or $75,000 at any time during the year. If you're married filing jointly, those numbers jump to $100,000 at year end, or $150,000 at any time. There are even higher thresholds for some people living abroad. What counts as foreign financial assets here? Bank accounts, yes, but also things like foreign stocks held directly, not through a US brokerage, certain foreign mutual funds, ownership interests in foreign businesses or partnerships, certain foreign trusts and pensions. And here's where many people are surprised. You may need to file both FBAR and Form 8938. They are not substitutes. They have separate thresholds, separate filing systems, and separate penalties. The third shield is understanding worldwide income. If you are a US citizen or green card holder, the United States taxes your worldwide income, no matter where you earn it or where you receive it. That means interest from your foreign savings account is taxable here. Rental income from an apartment you own abroad is taxable here. Dividends from foreign stocks are taxable here. Profits from a business overseas are taxable here. Now, that doesn't always mean you pay tax twice. The foreign tax credit, usually claimed on Form 1116, lets you generally credit income taxes paid to another country against US tax on the same income. The US also has tax treaties with many countries, but here's the key: you still have to report it. Even if, after credits, you don't owe an extra dollar, the IRS expects transparency. The system runs on disclosure. At this point, you may be thinking, okay, but what if I already missed all this? What if I'm watching this and realizing that for the past 2, 3, maybe 5 years, I should have filed FBARs and reported some foreign interest, and I didn't? This is where most people panic. And panic is exactly what leads to bad decisions. Ignoring letters, lying on forms, or rushing to file something incomplete without understanding the consequences. Here's what you need to hold on to. The IRS knows that many immigrants failed to report foreign accounts not because they're criminals, but because nobody ever clearly explained the rules. That's exactly why programs like the Streamlined Procedures exist. If your failure was non-willful, you have a legitimate path to clean this up. The key word, again, is non-willful. You must be able to truthfully state, under penalty of perjury, that you didn't know about the requirements and had no intent to hide money. That certification is serious. It's not something you just sign. But if it's true for you, it can drastically reduce your exposure. The critical condition is timing. You generally must act before the IRS sends you an audit notice or a penalty letter. Once they've opened a case on you, some of the best options may disappear. Now let's connect this back to citizenship more directly. When you apply for naturalization, USCIS looks at a statutory period, usually the last 5 years or 3 years if you're applying based on marriage to a US citizen. During that time, they evaluate whether you've shown good moral character. Tax compliance is a big part of that story. USCIS officers can review your IRS transcripts. They can see if you filed every year. They can see if you had unresolved tax debts, payment plans, or penalties. Imagine this scenario. Someone became a green card holder in 2018. They kept a small joint account overseas with their father. In 2022, after some family property was sold, about $8,000 was temporarily deposited into that account. For a few weeks, the balance crossed $14,000. They had no idea that this triggered an FBAR requirement. In 2026, as they're preparing to apply for citizenship, a careful tax preparer asks, "Have your foreign accounts ever exceeded $10,000 combined at any point during a year?" That's the first time they realize there might be an issue. Here's the difference preparation makes. Instead of ignoring it, this person works with a qualified professional, files the missing FBARs, amends returns if needed, explains the situation under the Streamlined program, and resolves everything before filing the N-400. By the time they walk into their citizenship interview, the issue is documented, corrected, and closed. There might be questions, but there's no surprise and no accusation of hiding. Now compare that to another situation. A woman receives an IRS notice about an unreported foreign account. She's overwhelmed. Maybe she comes from a country where contact from tax authorities meant corruption or intimidation. She assumes it's a scam or hopes it will disappear. She ignores it. Months later, a second, more serious letter arrives. Penalties and interest have grown. When she finally responds, the IRS is no longer looking at this as a simple, innocent oversight. What could have been resolved quietly becomes an adversarial process. The lesson here is not, be afraid. The lesson is, don't be silent. Silence makes small issues bigger. So what should you do tonight if you even suspect this might apply to you? Think of this as your step-by-step checklist. Step 1. Create a complete foreign account inventory. Write down every foreign account connected to you. Savings, checking, fixed deposits, joint accounts, business accounts where you have signing authority, retirement accounts, life insurance with cash value. Include accounts that are dormant but still formally open. For each, note the bank name, country, and account number. Step 2. Find the highest balance for each account during each year. You're not just looking at December 31st. Look at statements month by month and find the maximum amount each account reached during the year. If you're missing statements, request them from the bank. It may take time, but accuracy matters. Step 3. Add the highest balances together. For each year, add up the maximum balances of all your foreign accounts. Ask, did this total exceed $10,000 at any point? If yes, you likely had an FBAR filing requirement for that year. Mark those years clearly. Step 4. Evaluate whether Form 8938 applies. Now look at the overall size of your foreign assets. If you live in the US and are single, did your foreign financial assets exceed $50,000 at year-end or $75,000 at any time? If married filing jointly, did they exceed $100,000 at year-end or $150,000 at any time? Remember, this includes more than just bank accounts. If those thresholds apply, Form 8938 may be required with your tax return. Step 5. Review your worldwide income. For each year, list all foreign source income: interest on savings, dividends from foreign stocks, rental income from overseas property, business income, pensions. Then check your US tax returns. Does that income appear there? Was a foreign tax credit, Form 1116, claimed where appropriate? If income was left out, that's a gap you need to fix. Step 6. If you discover past non-compliance, consider the streamlined procedures immediately. Do not wait for a letter. Consult a tax professional with experience in international reporting and FBAR issues. Ask specifically about the streamlined filing compliance procedures. Be completely honest about your situation so they can advise whether you qualify as non-willful. The goal is to voluntarily correct before you are on the IRS radar. Step 7. If you're preparing to file Form N-400, run a citizenship compliance audit first. Before you even submit your naturalization application, request IRS tax transcripts for the last 5 years, or 3 if you're applying early through marriage. Confirm that returns were filed every year, that any tax owed was paid or is in a current payment plan, and that required foreign reporting forms, FBAR 8938, have been handled. If you've ever had an installment agreement or penalty, consider speaking with an immigration attorney to understand how to present that history. Let me boil this entire video down to 3 rules I want you to remember. Rule 1. If your combined foreign accounts exceeded $10,000 at any moment during the year, you must file FBAR. Rule 2. If you discover a mistake, come forward before the IRS contacts you. Voluntary correction through programs like the Streamlined Procedures can dramatically reduce penalties. Rule 3. Tax compliance and citizenship are directly connected. Always review and clean up your tax record before filing Form N-400. Now let's come back to that Tuesday morning email. The number on the screen, $16,536, feels heavy not only because of the money, but because of what it represents: uncertainty. The fear that something small and forgotten in another country could unravel years of sacrifice in this one. For immigrants, paperwork is never just paperwork. It's tied to identity, stability, and belonging. But here's what changes that fear: clarity. You now understand that the $10,000 rule is about combined, highest in the year balances, not just what's in one account at year end. You understand that foreign banks report data under FATCA, and the IRS uses automated systems to match that data to your returns. You understand that FBAR and Form 8938 are separate requirements, and that the U.S. taxes worldwide income, even when foreign tax credits mean you don't pay more overall. And you understand that honest mistakes can often be corrected, especially if you act before the government knocks on your door. Many immigrants carry a deep fear of government agencies because of experiences back home. In some countries, a letter from the tax authority meant harassment or bribery. So the natural instinct here is to avoid, to stay quiet, to hope it disappears. But in the US, while the system is strict, it is also structured. There are published rules. There are formal programs to fix past mistakes. There are appeal rights. The system generally rewards transparency and voluntary correction far more than concealment. Having financial ties to your home country is normal. It does not make you less American. It does not make you suspicious. You have the right to support your parents, keep an account for emergencies, or own property back home. The U.S. system is not judging your love for your family or your origins. It is enforcing reporting rules. Once you separate those two things in your mind, this becomes a technical compliance problem, not a judgment of your character. But technical problems can still create serious consequences if ignored. That's why I want you to take one concrete step after this video. Schedule time, tonight or this weekend, to start your foreign account review. Don't panic. Don't procrastinate. Gather your statements, make your list, and see whether the thresholds apply to you. If everything turns out to be compliant, you gain peace of mind. If you find a gap, you gain the opportunity to fix it early, on your terms. You worked too hard to build a life here to lose sleep over something that is fixable. You crossed oceans, rebuilt careers, learned new systems, passed interviews, paid fees, and waited years. Do not let a misunderstanding about reporting rules undo that progress. Preparation is power. Transparency is strength. Action is protection. If this breakdown gave you clarity, share it with at least one person you know who has bank accounts or property back home. Many immigrants simply don't know these rules exist, and the penalty for not knowing can quickly reach tens of thousands of dollars. Information is free. Ignorance is expensive. And remember, this video is education, not personal legal advice. For your specific situation, especially if you already missed filings, talk to a qualified tax professional and, if you're on the citizenship path, an immigration attorney. You are not a criminal for having an account back home. You are capable, you are responsible, And now you are informed. Handle it. Protect your future.